So since we're here today to talk about property, I thought that I would sort of mainly address our silent cyber risk while we model both affirmative coverage and silent coverage. As we're talking property today, silent seemed a little bit more relevant. So what we see here on the screen is our different levels of exposure. So we have all the way up from the top here of what we know we have cyber coverage for. This is our cyber affirmative products. We specifically, it's the line of business for cyber. The next one is what should be known. Now this is where you might write back cyber. So you've got a property policy and you're not sure whether it includes it, excludes it, etc., but you've decided we're going to include it, we specifically write it back in. The next one is where it's unclear. So due to your policy wordings, you're not 100% sure whether you actually cover this or not. You might not. We'll see as it goes. And the last one is finally your silent wording. And this is proper, no cyber wording whatsoever. This is your proper silent. You don't even know it's in there. And that's sort of the last two, the unclear and the silent, are sort of what I'm going to be talking about today. So what we see on this side here is all our different sorts of coverages and where they might link into cyber. So our big red circle in the middle is our affirmative cyber coverage. And that goes through typical things we see here. Hold on. Sorry, I'm just going to walk with this. Okay. So what we see here is things we would think of for affirmative cyber. We've got our incident response costs, our breach of privacy, security liability, etc. These are all quite clearly cyber affirmative policies. Now, where those interact with our other policies, we see here. Since we're going to be focusing on property today, let's look at that. For property, we know we cover physical damage, we cover BI, CBI, etc. That's in your property policy. But what you might not know is that you're exposed to cyber in that as well. Unless you specifically exclude it, you probably have a bit of cyber coverage. So what that would be these ones here. So you've got your non-damage BI. That's a huge one. I mean, how many policies actually say you have to have physical damage to cover BI? Most, well.
At least in German-speaking markets, all.
Okay, well, we have seen on a number of occasions policies that do not include that at all, and I have an example coming up, actually. And then the same on the CBI. Could you be, on the hook for CBI costs from a cyber event? So this is just a quick overview of that. And to move on a little bit to how we actually model cyber. So we have 5 basic pillars that we use when we start to model our cyber risk. So these are our broad general categories that we look into in quite a lot of depth, and this is everything that informs our modeling. Not everything that I talk about here actually specifically goes into our model, but we think it's really important to be informed in these fields as much as we can to improve our modeling. So our first is our threat landscape. That is, who are these actors? What do they want? How capable are they of doing these attacks? There's a big difference in our threat landscape and our actors between a nation state, such as North Korea, Russia, etc., and, as we've been talking about, the kids in the bedroom hacking away, trying to break into the NSA just for fun. There's a big span in there. Are they terrorists who want to perpetrate this for an ideological reason? Are they out there for themselves and they just want to get some money? There's a big scale there of the different actors that we're talking about. So we work with Cambridge University and we assess all of these actors. They've got some really, really smart people there in their Center for Risk Studies, including hackers and other cyber experts. So we work with them on that. Our next pillar is going to be our attack vectors and our loss mechanisms. So that is, now that we've sort of looked at who the actors are, we're going to look at how they perpetrate these attacks. So this is sort of along the lines of what you would think of maybe as your peril if you were thinking a bit bigger. So this is going to be, is it a denial of service attack? Is it a cloud failure? Is it a ransomware, an extortion event, etc.? So we look at all of those different attack vectors, and importantly, as I'm going to talk about later on, we're going to look at how they scale up. So there's a difference between day-to-day, now your attritional attacks, and how big each of these can scale if you want to look at the catastrophic potential of these. So our third pillar is our company vulnerabilities. These are things, if you're looking at a specific company, they're going to be, are your ports secure? How is your actual IT security, your infrastructure, etc.? But more than that, it's a personal element as well. Have you trained your staff? Do they know not to click on those phishing emails? I mean, I think probably all of our companies send us those fake phishing ones, and if you click on them, it goes to a big screen that's like, ooh, you failed. No, you don't have those? No. We have those. These sorts of training policies are quite important as well to look at, because a lot of this can be perpetrated almost accidentally, or there's a lot of human error involved in some of this, so that training is important to look at as well. Our fourth one, digital assets. This is what sort of data does the company hold? Is it personal information? You know, that would be covered for GDPR. Or is it healthcare information, which is probably also covered? But for example, these different levels, is it credit card information? And as we all, I'm sure, are aware, each of those different, personal identity, healthcare, credit card, they all have different cost levels on the black market. So healthcare is known to be the highest charging on the black market. If you have healthcare data, you can charge quite a lot for that. So it's looking at that. Also, as to what type and how much data you hold, it's how important are your computer systems to your daily business. Are you British Airways, where if your systems go down, you're going to be in trouble? I mean, and we've seen this with airlines where systems have gone offline, and it causes all sorts of chaos because those computers are so integral to the company, from online bookings, checking people in, talking throughout the airport between the security and the gate, and after that through airports around the country, around the world. If those systems go down, you're going to be in big trouble. Or on the flip side of that, are you a farmer? Where, yes, a lot of farming is becoming increasingly mechanized these days, but if you lose your systems, you can probably survive for a couple of days without it being a catastrophic loss. So we look at the different sectors for that. Now, our fifth pillar here is insurance losses, which is, as we all understand, the economic loss of an event does not necessarily translate into the insurance loss of an event. Especially in cyber, there's a very large difference. So we've spent a lot of time researching the different coverages and how in different cyber attacks, those coverages are going to take loss. So those are sort of our 5 pillars that underline everything that we look at. So from there, we can see that's quite a lot of information that I've just talked about, and we have even more. So if we look at how we build our models, on this side, we have our different sources of information. So we have our threat intelligence that we work with Cambridge and other experts on from there. We've got our cyber incident data. This is historic data that we have collected, as well as cyber telematics here, and et cetera, et cetera. Importantly, we also have loss and claims data from our clients. And we have clients that are happy to work with us to provide this information so that we can calibrate this model to actual realistic loss claims. So all of this information gets sucked up into, one giant pot. And as you can tell, that's a lot of information. We have actually a team out in India that they web scrape the internet for anything talking about cyber. So when that gets put in, it's a lot of data. So what we then do when we get this all compiled is we use machine learning on it. So we filter out of all of that data what is useful and what is not useful. Because a lot of that, obviously, you can understand isn't going to help us very much. So once we filter out all the useful information, we can piece it together where we say, oh, over there's a little bit of information on this attack, and over there a little bit more about the same attack. So we can piece it all together and have this framework that we use. And from there, that is the information that we use to build our models to run data. And the output of that, these are the loss processes that we model. We model both IT and cyber physical. So IT is information technology. That's going to be more along the lines of what you typically think of as cyber risks. So you've got your data exfiltration, your denial of service, your malware, et cetera. Then the cyber physical side, that's going to be more along the lines of trying to test, say, your property policy, for example, and where that can be. So these are going to be actual more physical events that are caused by a cyber trigger. So we've got power blackout, which is a Lloyd's scenario, property fire, marine cargo, et cetera, offshore. I should mention that we actually have our own power blackout as well as the Lloyd's, but I mentioned that because you might be familiar with it already. So we have 10 models in total. And I'm going to continue on, and I want to talk just about contagious malware from here on out. This is something that you're probably familiar with already, and we can see how it's going to scale up into an aggregate event. So what we see on the screen here, this is our scaling factor for each of our IT loss processes. So the first row of bubbles, this is going to be our current annual cost. This is what we have seen today, which makes sense. If we look, data exfiltration is the largest bubble. And that sort of makes sense. I mean, a week can't go by before somebody else has a hack or they've lost data over there or et cetera. It seems to be happening all the time. So it makes sense if we think from our own experience that, yeah, okay, data exfiltration could be the largest cost right now. But what we also see next to it is contagious malware. And I just want to point that out because we've had two major attacks fairly recently, the WannaCry and the NotPetya, which were pretty, people talk about as being pretty severe attacks, and they were. They weren't catastrophic, but they were pretty severe, while it's still a fairly small bubble. So now let's look at the second row, which is our scalability factor. This is going to be how scalable each of these loss processes are. So as you go up the return period, and you want to talk about your RP200, for example, how high up are these going to scale? Now we see while data exfiltration is our largest cost right now, it doesn't scale very much. And there are reasons for that. It's looking at and understanding data exfiltration as a loss process itself. Now what that means is data exfiltration, that's where you hack in, you steal some data, you take it away, you sell it on the black market, et cetera. That's actually an incredibly manual process. It actually requires someone sitting at a computer and hacking into your networks to take your data and then go sell it. So the fact that to scale that, you actually need more people hacking. So there is sort of a limit to how many people you can get doing this at one time. And on top of that, if your main goal in this is to get data to sell it on the black market, you don't necessarily want to steal all the data that you can possibly get. Because if you flood the black market with data, the price per record is just going to drop. And if you're stealing this to sell it, that's not what you want. So there is sort of a curve, a sweet spot of where this doesn't necessarily scale any further. Now, on the flip side, if we look at contagious malware, that has a huge scalability factor. And the reason for this is that a lot of it is automatic. It's not manual. The manual part is building the code. Once you release that code out into the wild, a lot of times you don't have to do anything else to it. It just goes. And it goes from network to network, company to company. It can keep going forever until someone stops it. And that is why if you get a particularly bad malware strain, that's where we're going to be looking at our real catastrophic damages. So, to talk about that a little bit more, I have a historical example. The WannaCry attack. In May 2017, this was a malware attack that affected Windows XP and Windows 8 servers. It caused 300,000 infections across 150 countries. However, I will say, importantly, 85% of Windows 8 users were protected because a patch had been released. When was it? 2 months before. So 2 months before this event, a patch was released, and if you updated on time, you were good, you were fine, 85%. So that only leaves 15% that was vulnerable to this, as well as all our XP users who, that's not supported anymore, so they're in big trouble. So if you take anything away from this, it's patch. Patch your systems. And we all do it. You get the little reminder on your phone that says it's time for an upgrade, and everyone goes, remind me later, remind me later, remind me later. You don't want to do it now, but it's actually really important, so please do upgrade your systems. So eventually, the WannaCry attack was stopped when they found a kill switch in the code. A researcher looking at it, they found a kill switch, they made it stop. And in total, it's estimated to have caused around $500 million in damage. Now that's economic losses. So what we do at RMS is we look at that as a historical event, but we also look at what could have been. One of our colleagues, Dr. Gordon Wu, he looks at counterfactual analysis. Now what that is he looks at this attack and he says, well, what if this had played out differently? What if certain parameters had been changed? How could it have been so much worse? So actually we look at things like the kill switch. What if that kill switch wasn't in there and it just kept going forever? How would you have stopped it then? What could have happened? Also, what if the patch for Windows 8 hadn't been released yet? What if all of Windows 8 was vulnerable? Further on, what if it affected more than XP and Windows 8? What if it affected other types of computers as well? So those are sort of all the what-if counterfactual scenarios that we can look at for this. And when Dr. Gordon Wu looked at this, he decided, the result of his research was that if you didn't have the kill switch in that code, it would have resulted in losses of 3 to 6 billion, which is a significant increase from the $500 million that was estimated in the actual attack. So this is one of the ways that we start to look at the higher end of the EP curves by looking at these counterfactual scenarios. Another real-world example that I want to talk about is Merck, which was mentioned earlier. Now, this was a different attack. This was the NotPetya attack in June 2017. This was, again, classed under malware, but it's a little bit of a misnomer. It wasn't ransomware because there was no ransom. It was a wiper attack. It just went in and wiped everything. That's sort of the highest impact malware attack that you can have, because with ransom, at least you have the choice, do I pay it and get my info back? Again, you may not, or it may be corrupted, but there's sort of a little bit of a chance that you might get it back all fine if you pay. With a wiper, there's no chance of that. It goes in and wipes your system and you're done. They're not looking for a ransom. So it was quite a high impact attack. Now, Merck themselves in this event, they lost $750 million. And what I want to point out today when we're talking about the property market is that they were able to recover $275 million of that claimed on their insurance. Now, yes, they did have cyber insurance, cyber affirmative, but at least some of that was brought on their actual property policy under BI because they did not have a damage clause in their property BI. So at least some of that $275 million came under their property policy. So this is sort of what I would like to highlight in, I know I spent a lot of time running through how we actually build it and et cetera, but this is a good example of this attack hitting all of those levels we talked about in the beginning. From our known of our cyber policy, yep, you're gonna probably take losses on this event, to our write-backs, you have a property policy with a write-back, you're gonna take losses on it, down to our sort of unknown, probably still, and into the silent. This is an actual example of a silent loss to this insurance company. So that said, we work with quite a lot of our clients on looking at their silent exposure. And this is basically the takeaway from this presentation is be sure you look at your coverages, look at your wordings, try to understand if you're going to be on the hook for silent cyber if something happens. And it's more than property. It's liability, it's E&O, D&O, even kidnap and ransom if you have a ransomware. So this silent can be into any policy. So take a look into it, maybe do a little bit of modeling on it, and talk to me if you have any questions. Thank you.
Okay.